This is episode 252 of Zen and the Art of Real Estate Investing with my guest, Eric Burns. Eric is the founder of Flowers Capital, where they help entrepreneurs establish passive income through commercial real estate investment. He is also a former firefighter turned entrepreneur. Eric, welcome to the show.
Hey, Jonathan, thank you for having me.
Yeah, good to talk to you. And we have had some firefighters on, so I want to start there. When in your firefighting journey did you start thinking about real estate as something that might be a big role later?
Okay, so real estate for me started as a single family residential property, and it started as a side hustle.
Yeah,
So, as you probably know, firefighters are big on side hustles and side jobs like that. So,
I got a
I
lot of contractors in there. So a lot of it does have to do with houses, though, for firefighters, because they're always in houses. Was that part of it, or how did you come upon real estate as something that to be
absolutely,
that side hustle?
yeah. So I did the grass company, and I did some building construction, and I knew that I needed to kind of get into something a little bit, but none of it really took off like I had hoped.
Yeah,
So I kind of just heard good experiences about a rental property at the kitchen table, and the guy said, "Yeah, it worked for me." And I thought, "Hey, this is a great idea."
yeah.
So I went out and I bought a single family student housing rental. And from the time I decided to buy it to the time I got it was about 3 months. So I just kind of leaped in. And then after that, it was kind of the time to figure out, how do I be a landlord? How do
Yeah.
I just kind of took the leap
What did I
because
get myself into?
absolutely, because the guy said it was they approved, and they said it was a good idea. I thought, why not? And so yeah, I just kind of started out as a side hustle and just grew from there.
I think a lot of people who start in single multi and small multifamily get to the point where they're like, yeah, this is a full time job. And now I have two full time jobs. So they figure out the way to scale up. But you sought masterminds and other help to get you there, which I think is super helpful. But it is a little bit harder now because there's so much content out there and so many false classes, good classes. It's hard for new people to kind of know which one. But you did get that personal reference, which I think really helped, which is something that
Mhm.
the listener should really look for. Can you have someone within your circle or circle of circles that can verify, hey, no, that's a good program. You're going to be money well spent there.
Mhm. Yeah, 100%. There's good ones and bad ones. Do your research and make sure that the person you're looking to learn from is a person that you want to emulate. For
Yeah,
one,
yeah.
that their content is robust and that they've done what they say they've done. So the mastermind I'm in now is actually solely for capital raisers. It's a little more focused, and it's called Raise Masters. And Hunter Thompson actually wrote a book
Yeah.
on raising capital, and I loved the book. And I thought, man, this seems like a great fit. And I got to know a couple of the guys that were in his company,
Yeah.
and I really kind of realized it was a good fit. And when you're choosing a mastermind, I always like to kind of make this point. Um, Usually you're going to be you're going to be starting at the bottom of the learning curve. So, and a mastermind steepens that curve so much, and even more so. And I always joke, it's like there is totally dumb questions to ask,
Yeah.
but the what you need to do is find a group that you can be humble enough to ask them, for one. And when you ask it, they don't make you feel like an idiot.
Yeah. Yeah.
It really kind of encourage that. And then you found a good fit, and your network is your knowledge. And that's really what I gained from the mastermind: support, accountability, and knowledge. Most of the app operators I work with now and I raise money for, their deals, I know them on a personal level from
Yeah.
a mastermind first. So the way I actually work with operators is I usually know them on an organic level. And then from there, I kind of know there's somebody I'd like to work with. And then I evaluate the markets they're in, then I evaluate the deals they're in and things like that. But generally, if generally they're people I want to work with and I know. So the market, they're great operators. They're already working in great markets.
Yeah.
That usually takes care of itself. They're getting great deals because they're great operators. That usually takes care of itself. And the biggest part, and I think people are starting to kind of double back and really kind of be more careful. I'm a little more diligent about who the sponsor they're looking to work with,
Yeah.
and I'm very proud of the base of sponsors I use. and I'm very confident in their abilities. So the biggest part of the vetting process is that sponsor. And even sponsors that are good sponsors, with the way interest rates hit us, the last couple of years, they hit tough times, and it doesn't make them a bad sponsor. It just, but how they handled it
Exactly.
is kind of the crux. Like, that's what you want to know. And are they standing up when times are tough? And I know I work with a lot of operators that navigated that situation perfectly
Yeah.
and are really buying well now, and they're buying at discounts, and they were disciplined. And I know some other operators that are good, and they're just making right on their deals to their investors, and they're not really walking away with much, and they're putting their investors first as much as they can, and that's important.
Yeah, and the transparency in the process becomes really important because for a lot of LPs, if whether depending on how many times you've been an LP, you don't have any control. But what you want is the transparency to understand in that monthly, like, hey, what's really happening, especially when there's been some issues over the last couple of years, a lot related to debt or construction stoppages. But I just rather know up front and not get the capital call notice, to just say, hey, we messed up here, give us some more money, please. I don't want that at all. I want to be, 6 months ahead of that.
Yeah, and then if you're getting a quarterly update and something is wrong in month 2, then say, "Hey, we're hitting a snag. Here's 2 ideas we think we're looking into to solve the problem
Yeah.
and right the ship. Just be aware that, there's ups and downs in any deal,
Yeah.
and
Yeah.
whether
Yeah.
in any asset class, there's gonna be ups and downs, and say, hey, the NOI might be a little low here in the next couple months, but here we're looking to kind of lower expenses in this area and make up for it, whatever it is. But that transparency and just being upfront about uh not only is there an issue, but also come with a plan to solve it right away.
Yeah, I mean, then you feel comfortable as a limited partner. I don't think you don't want to be surprised by something
Mhm.
that you should have known before or feel like you're kind of getting tricked or suckered into something else. And I think that's where again, building the relationships and for you, making sure that your box of sponsors that you like to work with is, pretty tight and people get in there if they've proven themselves. And if they do something, yeah, they may go out of the group, but you made a good point. Not every sponsor who's having issues over the last year and a year and a half is a bad sponsor. Some, deal was okay. The asset's still good. They just kind of have to reposition capital to make sure that they can cover, especially for those construction ones that also had bridge debt. If you could give one piece of advice for a skill that somebody would need to be good at capital raising, what do you think would be something important that we might not have talked about?
I think being disciplined in who you're willing to work with is
Mm,
one, and I think being patient and with the investor is another one.
yeah,
To not rush an investor and just make sure that you're being patient, and that you're, and for me, it was something as important, like I mentioned, is growing with an investor and looking at it as a long-term partnership and being patient with the investor or potential investor on where they are in their journey as well.
yeah,
If they're not there, then they're not there, and just being respectful of their space and being authentic and truly, and just truly making sure that you're not bringing a deal because you're chasing returns yourself.
yeah,
That that I need to be disciplined, and when I look at deals, and I think that's a skill that's very important. And
yeah,
that might be my main one is make sure that I'm looking at deals critically and that I'm not chasing returns, because people can get caught up in that and say, well, you've got a 16% and this other guy's got a 19, and
yeah,
rather do that one. It's like, whoa, how, and especially like an internal rate of return, it can be manipulated. It's like, well,
yeah,
how are they getting it for one?
yeah,
So that I need to go in and look at very critically with a critical eye at the deals I'm looking at. So when I come in, it's a deal that I believe in. And I think that goes a long way for investor trust, where they after time they'll see that I might be passing on deals that aren't, that the business plan isn't really, it might be a little ambitious,
yeah,
and and that's why the returns are high and things like that, and there's a lot of them out there
yeah,
even
for
still.
sure.